This is the Daily Market Comment for Wednesday, June 14th by Haralambos Pisuros. I'm Cristina Marujos, and thank you for joining us at xm.com. The dollar traded lower yesterday after data showed that U.S. consumer prices barely rose in May, taking the headline year-on-year rate down to 4% from 4.9%. That was the smallest increase in more than 2 years, adding to the view that the Fed is likely to skip raising rates today. That said, the core CPI rate only slid to 5.3% year-over-year, which is still more than double the Fed's 2% objective. Therefore, investors continue to see a decent probability of a July hike and nearly a quarter-point cut by the end of the year. With all that in mind today, market participants will be sitting on the edge of their seats in anticipation of the FOMC decision. Given that they are nearly certain that the Fed will refrain from pushing the hike button again, a skip on its own is unlikely to trigger much market volatility. The spotlight is likely to quickly turn to the updated macroeconomic projections and the new dot plot. If policymakers raise their median dot for 2023, the dollar could still rally, as this could be interpreted as a July rate increase and no cuts for this year. For the dollar to come under strong selling interest, the Fed may need to stay sidelined and signal that they are probably done raising rates, which appears to be the least likely scenario given how high underlying inflation is. But even if the dollar strengthens due to a hawkish pause, it may be premature to argue about a potential bullish reversal. There are more major central bank decisions pending in the days ahead, with the European Central Bank deciding tomorrow and the Bank of England next week. Hawkish rhetoric by those banks could push the dollar lower against the euro and the pound. Wall Street extended its rally yesterday, with the Nasdaq gaining the most as the CPI data added more credence to the case of the Fed taking the sidelines today. The tech-heavy index seems to be more sensitive to changes in expectations about interest rates, as high-growth tech firms are usually valued by discounting estimated cash flows for the quarters and years ahead. A lower implied interest rate path means higher present values for stocks and vice versa. However, with the Nasdaq rallying nearly 44% from its October lows and not decently correcting lower since mid-March, the risks of a short-term retreat likely continue to increase. The catalyst for such a correction may be a potential liquidity squeeze due to U.S. Treasury bill issuance. This was the Daily Market Comment. Thank you for watching at xm.com.